Lisa, we're heading towards the end of 2022. So what's your outlook for 2023? It's right around the corner.
It is. And, our perspective is that this is going to be a year where fixed income outperforms stocks. Our best guess is that the S&P 500 actually ends the year about where it starts, probably somewhere around 3,900 to 4,000.
Well, let's talk a little bit about economics before we talk about stocks. Do you see a recession in 2023?
No, we actually don't. And our call on that is really premised on our belief that the labor market is going to be quite strong as long as folks have jobs. They're going to keep spending. In addition, corporate balance sheets are reasonably healthy. And there are lots of reasons and incentives to invest in capital spending. So between capital spending, strong labor market, and consumption, we think we avoid a recession and the Fed kind of gets its proverbial soft landing.
So how do you, in essence, play the Fed? Because the stock market really is taking its cues from Chairman Powell.
Absolutely. I think that that's true. Our view is that that may be overplaying and giving Chair Powell a little too much credit. I think we're in a phase where certainly Powell has the power to decide at what pace he raises rates and potentially at what pace he decides to cut rates. But the reality is, at the end of the day, inflation is going to determine a lot of those things and discipline him in those things, as will economic growth. And he doesn't have control over those two variables.
Okay, let's talk about stocks again. What's going to happen with earnings in 2023? Are estimates too high now?
In our humble opinion, they absolutely are. Current consensus estimates, roughly around $230 per share, embed year-over-year growth of almost 5%. We're looking at a number closer to 195, and that really contemplates a degradation of both volumes, or the demand side of the economy, as well as a loss of pricing power. How do you get rid of inflation if it's not companies also who lose pricing power?
But even with a modest multiple, that means stocks are headed lower from here. What's your response to that?
We do think that stocks are headed lower in the very short term. Once expectations for these earnings get rebased, then we can start a new bull market. But it's really about those expectations, because ultimately markets move on the trajectory of earnings, and without the ability to surprise on the upside, which that $230 just doesn't give you, we're probably going to have to go down before we get back to flat.
Which means we have to buy and hold the right stocks. So let's dig a little bit deeper. So do you like small caps or large caps or mid caps?
So yes. So I don't mean to be flip about that, but what we don't like is the market cap weighted S&P 500 index. That index, given its concentration, both in terms of weights and in terms of sector, lack of sector diversification at the very top, is what has us concerned. So we're buying below the surface of the index, and there's a lot of things to buy that we think is offering not only good valuations, but some income opportunities. So on the more mid-small cap end of things, we are buying in biotech, we're buying in semiconductors, we're buying in software, we're buying in home builders, we're buying residential REIT. On the larger cap end of things, we're buying more traditional cyclicals, so financials, industrials, energy, and that's more for yield. And then in terms of some safety or some growth in the portfolio, we like some of the ideas in healthcare. We like some consumer services like the insurance companies.
All right. It's a little bit of an answer towards you like growth, but is that growth stocks versus value, or just a growth you're part of that particular sector?
Yeah, so we're value investors in the current environment. And the reason is that uncertainty is very, very high. As much as I've attempted to express some conviction in our call, the reality is that there's too many moving parts. Policy, we're in unknown territory. We haven't been here for 40, 50 years in terms of raising rates this quickly. Inflation, we haven't been here in 40 years. And we haven't had, the aftermath or the reverb after a pandemic and having this unleashing of pent-up demand. This is unknown territory. I want risk premium. I want to get paid to take risk. I want to own value everywhere that I'm playing, large cap, mid cap, small cap.
All right, and what about U.S. versus foreign stocks?
Yeah, no, so great question. US has obviously dominated to a disproportionate degree global portfolios over the last 12 to 13 years. 2022, in the second half of this year, we began to see that worm turn a little bit as some of the non-US or rest of world markets have begun to hold up a little bit better than the US. And our best guess is next year, you're going to see emerging markets actually outperform as they get rid of what has been four profound headwinds, right? They get to abandon the weight of COVID, abandon, hopefully the inflation shock of food and energy prices for them, the strong US dollar, and a China recession. Those have been four huge headwinds for EM that should lift in 2023.
Okay, we've sliced and diced stocks. Let's slice and dice bonds for a second. Munis, govies, high
Yep.
yield. What do you like?
Love it all. And the reason I love it all is because the first time, literally in a decade, I can get yield and I can get high quality yield without taking duration risk. So right now, I can own 2 and 3 year treasuries getting, about 4%. I take a little bit of credit risk, either in munis or high grade corporates. I'm almost getting 6. And if we are wrong about next year and there is a recession, growth slows even more, those yields could come in, bond prices go up. So total returns could approach double digits.
And then finally, why would you be wrong? What are the big risks out there? Give
Yeah.
us the fine print.
Yeah. So the fine print is, it's always there, right? So where could we be wrong? On the one hand, we're calling for weaker earnings growth. So where we could be wrong is perhaps companies are able to cost cut faster than unemployment in the economy goes up and hurts the aggregate. I don't know. I'm not convinced, but that would be, one key area where we might be too negative. Where could we be too optimistic is in our soft landing scenario, where we're giving credit to the strong labor market and to capital spending to cushion things. The reality is 500 basis points already, in the canon says that, there's a good chance over the next 6 to 9 months that is not a soft landing. It's a much harder landing, and we move rapidly into a recession.
All right, well, thanks a lot for coming on and talking about it.
Absolutely. It's great to chat with you.